Right, so in this video, I'm going to talk a little bit more about financial planning as it relates to cash flow. So if you think about what sort of drives what's going on with cash flow relative to an income statement or something of that nature, cash flow and income are not the same thing. They're of course related, but they're not the same. So let's talk about what drives some of the difference between them. So one of the things that drives the difference between cash flow and income will be that income is calculated on an accrual basis. So what that means is when people are creating the income statement, they are trying to match expenses and revenues with the period in which they are incurred, not necessarily the point in time at which the cash arises from that activity. So for instance, if I have a business that sells some product on account in one particular month, then on the income statement, we're going to show that there was a sale in that particular month. But I may not have actually collected the cash for that. So therefore, I would not have actually generated a cash flow from that sale yet until the person I sold it to has actually paid me. So that's where on the accrual basis, we're going to show that as a sale, which is then leading to income. However, it would not appear in terms of generating cash because we haven't actually collected payment for it yet. So if we're trying to come up with cash flow, we're focusing more on kind of the cash basis of things, trying to focus on, what has occurred in terms of actual cash. Now, there are some other things that could affect kind of the calculation of cash flow or affect cash flow. And that would mean that if I'm looking at depreciation, for instance, then we could have different things going on in terms of depreciation on from a cash flow standpoint relative to a an income statement kind of standpoint. So if you now first off, depreciation is non-cash, but it has sort of cascade effects that can wind up affecting cash. So let's kind of walk through that a little bit. So if I'm looking at one aspect of this would be if I'm looking at depreciation as it relates to taxes versus sort of generally accepted accounting principles, those can differ. So let's talk about generally accepted accounting principles first. So typically, from a standard accounting standpoint, the whole point behind depreciation is we're trying to account for the fact that my machinery is wearing out. And so I'm trying to record an expense that's capturing the fact my machine is no longer as capable as it used to be because it's partially worn out. So I'm going to try to measure the fact that this thing, or account for the fact that this machinery has worn out during the period. So I'm going to show depreciation as an expense during the period, even though no money went out the door as a result of this. It's just my machine is more worn out, doesn't have as much life left at this point. So from a generally accepted accounting principle, it's all about trying to match the lifespan of the asset, the value of the asset, with the dollar value on the balance sheet. So that's kind of what's going on with sort of a matching principle, or kind of a focus. On the other hand, from a tax perspective, we want to depreciate machinery pretty much as fast as we can. And the reason for that is when I show depreciation as an expense, it lowers my taxable income, which then lowers how much I need to send to the federal government and possibly state governments too. So if I'm thinking about depreciating this asset over its lifetime, if I spread the depreciation out, I save money in taxes over a long period of time. But if I could depreciate it all at once, I would save money in taxes basically now. So if you're faced with a choice, do I want to save money in taxes now, or do I want to save money in taxes over the next 10 years or 5 years, whatever the lifespan of the asset is? Well, from a time value of money standpoint, a dollar of savings today is better than a dollar of savings in 1 year, 2 years, 5 years, 10 years. So I would rather save taxes now. And so from a tax perspective, we would actually depreciate a piece of equipment as fast as the government will let us, which brings up an interesting point, and that is companies often have two totally different kind of sets of books. Not that they're doing anything shady here, but they have one set of books that is following generally accepted accounting principles to present financial statements that are consistent with that and so forth. But then they have another set of books to follow IRS regulations and what the federal government stipulates in terms of what's taxable, when it's taxable, how it's taxable, et cetera. Because the government has all kinds of rules all of its own about what triggers taxes and how much and why, and weird tax credits and including different methods of calculating depreciation. So we actually have kind of two sets of books, one that's doing the normal accounting, one that's doing for tax purposes. And so one of the things that can affect cash flow then is for if you think about depreciation, depreciation is non-tax, but it does, or non-cash, but it does affect taxable income. And so that can kind of affect things a bit. Also, if I just think about just using different types of depreciation, it's the same sort of thing. It's going to affect when the taxes would appear. So if I use an accelerated form of depreciation versus a straight line, it's going to affect taxes basically. So that can start to affect things. The big thing to think about, really, just as it relates to cash flow from depreciation, is that depreciation is non-cash. So I show it on the income statement as an expense, but no money left. So we have to account for that. And really kind of what's going on with the accelerated depreciations for tax purposes and things like that is basically the federal government is trying to incentivize investment by making a new purchase of equipment or machinery more attractive, basically. So that's kind of worth noting. So that brings up kind of what kind of depreciation do we do for tax purposes, because that affects taxes, which are cash flows. And there is a form of depreciation that is commonly used, or has historically been commonly used for quite some time now, and that is the MACRS, which I believe stands for the Modified Accelerated Cost Recovery System depreciation. And there's basically what they do is you classify equipment into classes based on, or groups based upon the lifespan or expected lifespan of the asset. So let's say I look at a piece of machinery, I think it's going to last 5 years. So this is now a 5-year asset under MACRS. And basically what I'm going to do is I'm going to look up in a table, and they actually have tables for the depreciation amount or depreciation percentage that you do in a particular year. And so basically what you'll do at that point is you'll just take the percentage and you will apply that to the depreciable basis, the value of the asset that's being depreciated, and there's your depreciation figure for the year. Now, an interesting little quirk is if I have a 5-year asset, and you're thinking, well, all right, I got to have a percentage for each year. So if I have a 5-year asset, a percentage for each year, so 5 percentages, right? Actually, no. Actually, what you'll have is 6 percentages. And this is where we have what's called a half-year convention. And basically what we're referring to here is the IRS is making the assumption that on average you'd be buying equipment at the halfway point in the year. And therefore, in the first year, they don't let you depreciate sort of a full amount. They're sort of assuming that you really only had the machine for half a year. And so as a result of that, if you have it for 6 sort of actual year-long periods, it's going to actually potentially span parts of, or sorry, for 5-year-long periods, it's going to actually potentially involve parts of 6 tax years. So if I start halfway through the first, a given calendar year, and then I do 5 years worth of life, then I'm going to wind up in a 6th calendar year, just because of the fact that I didn't buy it on January 1st of a particular year. And so as a result of that, a 5-year MACRS depreciation table will actually have 6 depreciation rates to account for the fact that the asset only lasts for 5 years, but it winds up sort of covering parts of 6 different years, or parts of 6 different tax years, I should say. So if it's a 3-year asset, it would have 4. If it's a 7-year asset, it would have 8. Yeah, that's the idea. And the main reason I've kind of brought up all this stuff about depreciation is depreciation is one of the major adjustments that has to be made. And one of the things you have to look at on a cash flow statement is you're going to have 3 sections of the cash flow statement. I talked about a cash flow statement in a prior video about financial statement analysis, so I'm going to briefly overview here. But the basic idea is we're going to have 3 sections of the cash flow statement. The first one is going to be cash flow from operations. The second is going to be cash flow from investment activities. And the third is going to be cash flow from financing activities. So cash flow from operations. This is really the cash flow that's coming in directly related to what we do as a business. So we're going to start at net income in that section. But then we're going to make adjustments to net income to account for some things that are related to our operations and make sure that we kind of get at what really happened from our operations. Pretty much the first adjustment you're going to make is we're going to add back the depreciation and any amortization that we took out on the income statement because it wasn't a cash expense. So I'm going to start with net income. I'm going to add back depreciation and amortization because those didn't involve actual expenses. Then we will make various changes or adjustments, I should say, to basically our cash flow from operations due to what's happened with changes in current assets and current liabilities. So if inventories went up a bunch during the year, then that took some of the money that I got from my net income and I stuck it back in inventory. And so if inventory increased, I'm going to show a deduction in my cash flow from operations section to reflect the fact I spent a bunch of my operating cash flow on inventory. And so a lot of it went there. So you'd make various adjustments in terms of current assets and current liabilities on the cash flow from operations section. Then we get to the cash flow from investment activities section. And this is going to be where you're going to factor in purchases or sales of assets like machinery, equipment, those kinds of things. So big expansions, that sort of thing. And you're going to track that. And I'll come back to this in a moment. So then you're going to get to your cash flow from financing activities. So if you paid off a whole bunch of debt, then that would be an outflow. If you borrowed a bunch more money, that'd be an inflow. Like if you sold stock, that would be an inflow. Bought back treasury stock, that'd be an outflow. And so basically, you're looking at all those kinds of things. So really, if you're thinking about what's going on here in terms of what's driving cash flow, so we have kind of our net income, we adjust for depreciation, possibly other non-cash expenses, and that's kind of a starting point for sort of what should be going on with our cash flow. But then we also have other changes in assets or liabilities or possibly the issuance of stock that also impact cash. And so this is starting from where the income statement is, but then it branches out into other things because different things are affecting cash compared to just the income statement. And basically what that's kind of getting at is we're starting with profits and adjusting for depreciation, possibly other non-cash expenses, and that's sort of hopefully sort of anchoring what's going on in terms of cash flow. But then we have these other sections of things that affect cash flow that would not be reflected in net income. And so that's essentially kind of what we're getting at here. Now, if you're thinking, what is it? How does this relate to financial planning? Well, if you start thinking about making plans for the future, you need to be thinking about, well, all right, if we're going to hopefully we're going to be selling product or services over this period of time, so that's going to affect my cash flow from operations. But also, if I'm planning for the future and I'm going to be investing a lot of money in expanding my business, buying fixed assets, building buildings, warehouses, whatever. Then in that case, then this is going to start to affect cash flow from investment activities and so forth. And ultimately, what we need to make sure that we've done is that as part of our plan, that we actually have an appropriate amount of cash flow that's coming in, it's appropriately balanced, it's going the right places, and we don't run out of cash and so forth. So you kind of have to look at kind of that whole picture, and it's kind of encapsulated by the kinds of things on the cash flow statement. And that's why I'm talking about it in this video. So make sure that if you start planning, you're thinking through, what are the implications? And I'll talk more about that when I talk about a cash budget as well. But hopefully this kind of helps and sets the stage a little bit. Thank you so much for watching and have a great day.